It's December 24th, Christmas Eve. While the Western herd is busy wrapping presents, downing eggnog, and assuming the trading year is a wrap, Wall Street is technically still online. But the floor's complete ghost towns. Liquidity is supposed to be dead. It's the perfect setup for a nothing burger day. And that complacency is exactly why what went down next was so catastrophic. Because while the West was sleeping at the wheel, the East didn't just nudge the silver market, they completely shattered it. I'm not hyping this up. This isn't some YouTube clickbait. We are witnessing events that are theoretically impossible in a rigged financial system. The foundational pillars of modern banking are crumbling in real time, and the masses are oblivious. Not because it's minor, but because it's hitting on a holiday when nobody is watching the screens. At 3:30 a.m. Eastern, the Shanghai Gold Exchange and the Shanghai Futures Exchange kicked off trading. What happened in that first half hour wasn't just volatility, it was a structural failure. The kind of price action that wakes risk managers up in a cold sweat. This wasn't a glitch. This was the dam breaking. We've been tracking this divergence for months. We showed you the physical stacks draining from Western vaults while the COMEX kept shuffling paper contracts. Two markets tethered for decades finally snapping apart. Today, that slow drift turned into a violent separation. Silver on the SGE closed at $77.89 an ounce in U.S. terms. Meanwhile, the COMEX in New York was sitting at 72. Same element, same timestamp. A spread that massive isn't an inefficiency. It's a siren. It screams that the arbitrage trade, the glue holding the paper scam together, is dead. And when the arb trade dies, normalcy leaves the building, timelines compress, volatility goes vertical, and systemic cracks that usually take years to show up start ripping open in a matter of days. This is how the fiat system ends, not with a bang, but in the silence of a holiday, when the watchdogs are off duty. If you want to grasp the magnitude of this collapse and where we are heading, lock in. Let's break down the data because this is where skepticism turns into panic. Shanghai Silver locked in at $77.89 an ounce priced in actual greenbacks. Not UN, not some crypto peg, real dollars. Simultaneously, New York paper silver was drifting around 72. Depending on your data feed, maybe a tick higher or lower, but undeniably cheaper than the physical reality in Shanghai. That is a spread of roughly $5.66 an ounce. Let that sink in. In a rigged commodity market, that gap is illegal by the laws of physics, not for minutes, definitely not for hours. Since the 1980s, the whole game relied on one rule. Identical assets must match in price via arbitrage. In a functioning market, that gap vanishes in milliseconds. Banks, algos, and hedge funds would scoop up cheap New York contracts, take delivery, ship it east, and sell for a risk-free windfall. That isn't gambling, it's mechanics. It's how the global casino stays level. But nobody moved. The gap didn't close. It stood there. Then it blew out wider. That is the tell. When there is free money on the table and the sharks don't bite, it means the trade is impossible, not because they are incompetent, but because the plumbing is busted. Here is the red pill. The price on your COMEX screen isn't the price of silver. It's the price of a digital promise, a paper IOU. When you try to convert that paper into actual metal, the system locks up. Delays hit. Premiums skyrocket. The metal vanishes. Shanghai is revealing the true price of physical reality, the cost of metal you can actually hold and use. New York is just broadcasting a fantasy number based on the assumption that everything is fine. Markets don't implode all at once. They snap at the weakest point. Right now, that point is the lie that paper derivatives equal physical silver. Once that delusion shatters, the entire world gets repriced. To get why this spread is sticky, you have to understand the mechanics of a healthy market versus this broken mess. Normally, a $5 arbitrage window would trigger a stampede. Every bullion bank and high-frequency bot on Earth would be buying low and selling high until the prices matched. No crystal balls, no speculation, just pure execution. But that trade is dead in the water. There is only one reason a risk-free arbitrage fails. You cannot move the metal because it isn't there. When the big boys try to buy New York silver at 72 and demand physical bars for those contracts, the game freezes. What looks liquid on a monitor turns into concrete the second you ask for delivery. You get delays, you get cash settlements, you get silence. This is the exact moment where the paper price and the physical price file for divorce. Shanghai is bidding 77.89 because the buyers there aren't playing with charts. They want the bricks. They are draining the vaults, they need possession, and they are happy to pay up to secure it. This is why the ARB is broken. You can't ship a phantom bar that doesn't exist in the vault. Once arbitrage dies, price discovery is gone. The global financial system rests on the faith that delivery is just a payment away. When that faith evaporates, prices stop matching and start fracturing across borders. This is the shift from a financialized market to a physical one. The question isn't, what is the spot price? The question is there any silver left to buy? And once scarcity is in the driver's seat, the price stops asking for permission to moon. When we hit this phase, velocity is king. Most normies just watch the price tag. The veterans watch the speedometer. The speed of the move tells you if this is a managed rally or a total systemic loss of control. Human brains love linear lines. If silver climbs $10 in 10 months, we expect the next $10 to take the same time. That logic works in peacetime, but it gets you killed in a currency collapse. When the rig breaks, price doesn't walk. It teleports. Zoom out on the chart. The grind from 20 to 30 took 5 months. 30 to 40, another 5. Slow, boring, safe. That is a standard bull market. It gives you time to stack hedge and keep your emotions in check. Then the rhythm snapped. 40 to 50 took a month. 50 to 60 happened in less than 2 weeks. The timeline compressed by 70%. The sellers effectively went on strike. Resistance lines melted. Liquidity dried up. The steady climb went vertical. This is the parabolic blow-off top. The moment technical analysis fails and survival instinct takes over. Dips are shallow and vicious. Volatility explodes. Confidence turns into panic buying. Hesitation becomes a very expensive mistake. At this level, nobody cares what silver costs tomorrow. They just want to know if they can get it today. Scarcity overrides valuation. Panic overrides patience. Parabolic moves don't stop because the price gets high. They stop because the infrastructure breaks. Liquidity, logistics, trust. It all snaps. And right now, it's not just the price breaking out. It's the entire ledger system beneath it. To see why the machine is smoking, you have to look under the hood at the plumbing. This is where retail traders tune out and the pros start sweating bullets. I'm talking about swap rates. This morning, we got a terminal red alert. The 1-year silver swap rate minus yields went negative, not a blip. Deeply negative by over 7%. That number is the physical market screaming that there is no metal left. In a sane market future, silver is cheaper than spot silver. Why? Because holding metal costs money. Storage insurance guards. Those costs usually push future prices up. That's called contango, and it means the market is healthy. Silver is doing the exact opposite. We are in massive backwardation. The market is paying a premium for metal right now. Buyers are eating a 7% loss just to get their hands on the bar today instead of next year. That isn't trading. That is a run on the bank. In plain English, the market is screaming a warning. It is saying, I do not trust paper promises anymore. I need physical metal in my hand right now. This mindset isn't coming from day traders flipping contracts for a quick buck. It is coming from the big players who can't run their businesses on IOUs. We are talking about the industrial whales here, massive manufacturers, global supply chains, companies that go dark if they run out of silver. They couldn't care less about the technical charts or RSI levels. They don't care about the dip. They care about keeping the assembly lines moving and staying alive. When we see backwardation this deep, it is not just a pricing glitch. It is a full-blown supply shock. It proves the just-in-time inventory scam has finally collapsed. Buyers are raiding the vaults, grabbing every ounce of physical metal they can find because they know future delivery is a gamble they can't win. This is the exact moment where the rigged casino stops acting like a market and starts looking like a systemic stress test. To understand how critical this setup is, you need to zoom out. We have seen silver backwardation before, but never this severe, and never for these reasons. Everyone always points to 1980 and the Hunt brothers, but that is a lazy comparison that misses the point entirely. Back in 1980, that squeeze was purely speculative. It was just 3 guys using massive leverage to corner the futures market. It was a financial game, not an industrial crisis. And because it was built on debt, the regulators just changed the rules, hiked the margin requirements, and killed the liquidity. game over. We saw a similar movie in 2011. Backwardation popped up again as retail stackers piled into silver after the banking crash. Everyone feared the dollar was dying. It was intense, but it was driven by emotion and fear. And fear is fragile. The banks smashed the paper price, shook out the weak hands, and the cycle reset. But what is happening today is a completely different animal. This squeeze isn't coming from speculators trying to moon their portfolio. It is coming from industrial giants and sovereign nations draining the physical supply. These buyers aren't trading on margin. They aren't emotional. And they are not going to sell their stack just because the paper price drops. A solar panel factory cannot pause operations just because the spot price dipped. An electronics giant cannot wait for a better entry point when they have contracts to fill. These buyers are price inelastic. They will pay whatever premium is necessary because a factory shutdown costs infinitely more than expensive silver. That is why this setup is exponentially more dangerous than any squeeze in history. You cannot margin call a company that pays cash for survival. You cannot change the rules to stop them. They aren't trading paper contracts. They are securing the lifeblood of their industry. When the market flips from I want to buy to I must have it or I die, the rules of the game change instantly. The spot price stops rationing demand. Physical availability becomes the only thing that matters. And once a commodity crosses that line, nobody cares about volatility or charts anymore. The only risk that matters is the empty vault, unobtainium. Now try to think like a bullion bank for a second, because this is where it turns into a nightmare for them. These banks exist to skim profits off the spread. They sit between buyers and sellers, keeping the game going. But their whole model relies on the lie that they can always source metal if they have to. Today that bluff is being called. A bank can sell paper silver without holding it because they trust the swap market to bail them out. If they need to deliver, they just lease it from another bank. That trust is the glue holding the scam together. When swap rates go negative, that trust evaporates faster than fiat currency and hyperinflation. The banks stop lending metal to each other, not because they are mean, but because they are terrified of being left holding the bag. Picture a risk manager needing to find 1 million ounces for delivery next week. In the old days, easy work. Today, absolute panic. When they call around to source that metal, nobody's picking up the phone. Everyone is hoarding. Everyone is protecting their own stack. Suddenly, the bank is caught naked short. They promise delivery on metal they don't have and can't find. If they go into the open market to buy physical, they will send the price to the moon and blow up their own balance sheet. Every option is a trap. This is the definition of a doom loop. The banks that actually hold physical metal are taking it off the table. No more leasing, no more swaps. They are in survival mode. Liquidity dries up not because nobody wants to trade, but because nobody is stupid enough to trade real assets for paper promises anymore. This is how the rigging breaks. It doesn't always happen with a loud crash. Sometimes the gears just grind to a halt from the inside. And once that institutional trust is shattered, there is no money printer in the world fast enough to fix it. This brings up the question the normies always ask. Won't the government stop this? Can't the regulators just halt trading and reset the game like they always do? It is a fair question, but it shows they still think the paper market controls the physical reality. Sure, the COMEX in New York can halt futures trading. They can turn off the screens. They can declare position close only. We know they have those tools, but there is a massive difference that people fail to understand. You can halt the paper game, but you cannot halt the laws of physics or supply and demand. If the New York futures market shuts down tomorrow, the world still needs silver. Factories don't stop running. Contracts don't vanish. Solar panels still need silver paste. EVs still need contacts. The real economy doesn't pause just because a computer screen freezes. The Shanghai Gold Exchange doesn't ask New York for permission to trade. The physical market moves where the metal is needed, not where the regulators want it. When the paper markets freeze, the real metal just roots around them entirely. If they halt futures trading, the backwardation gets worse, not better. The shortage becomes undeniable, and the price of actual physical metal will skyrocket while the paper price becomes a meaningless number on a dead screen. This is how true price discovery happens. Not through press conferences, but through sheer necessity. Once buyers bypass the COMEX, the spot price loses all credibility. A price without metal backing it is just a lie, and lies don't keep factories running. This isn't a temporary glitch in the matrix. This is a complete regime change. Once the cartel loses control of the physical flow, they never get it back. Now let's look at the smoking gun. The part where theory meets hard reality. You can argue with analysts, you can debate the charts, but you cannot fake vault inventory. The numbers don't lie. While everyone was staring at the fake spot price, the smart money was moving the metal. Massive amounts of deliverable silver were being drained from Western vaults right when prices were hitting highs. That is the opposite of how a healthy market works. High prices should bring out sellers. Instead, the silver is vanishing. This is what a modern-day bank run looks like in the commodities market. You won't see people lining up around the block. You'll see armored trucks leaving the depositories. It is the big money choosing physical possession over paper promises. They know that if you don't hold it, you don't own it. Registered inventory, the stuff that is actually available to settle contracts, is bleeding out. That pile is the only thing giving the paper market any credibility. When registered inventory hits zero, the whole charade comes crashing down. And this is happening at the absolute worst time for the riggers. The banks are short, industry is desperate, the arbitrage is broken. Every bar that leaves the vault tightens the noose around the manipulation. Here is the psychological shift that changes everything. Once people realize the paper is worthless, they demand delivery. Nobody wants to be the bag holder. Nobody wants to find out the vault is empty when they show up with their claim check. This is how confidence dies slowly, then all at once. A paper market can handle volatility. It cannot handle a mass exodus into physical metal. Because once enough people demand reality, the illusion evaporates. At this stage, the market isn't balancing anything. It is exposing the truth. It is showing us where the metal actually is. And spoiler alert, it is not where the spot price says it should be. So here is the bottom line. This isn't a bubble and it isn't a dip. It is the end of an era. We are shifting from a price set by leverage and paper games to a price set by physical availability. Real money is taking over. Let's break down exactly what this means for your stack. First, when the arbitrage breaks, markets stop being global and start acting local. The price no longer reflects theory. It reflects access. Whoever holds the physical metal supply controls the outcome. Second, when backwardation becomes extreme, it is not signaling an opportunity. It is signaling massive stress. It tells you the system no longer trusts the paper market to deliver what it promises today. Third, when vault inventory drains during record prices, that is not profit-taking. That is fear. It is smart money, choosing physical certainty over paper yield. That flow almost never reverses quickly. For investors and stackers, the big mistake at moments like this is chasing headlines or timing tops. This is not about guessing the next dollar move. It is about understanding regime change. In regime shifts, volatility increases, pullbacks shorten, and narratives flip faster than most people can adapt. The smartest move is not panic, it is preparation. Reduce reliance on leverage, understand counterparty risk, separate paper exposure from physical reality, and above all, stop assuming that yesterday's fiat rules still apply. Rigged markets do not warn politely when they change character, they demonstrate it. What we are seeing now is a financial system repricing trust itself. If you have made it this far, you are already ahead of most participants. Stay observant, stay disciplined, and do not confuse a calm screen with a stable banking system. If this analysis helped you see the bigger picture, take a moment to subscribe, smash the like, and share this with someone who still believes nothing happens on holidays. Leave a comment with number 1 if you want continued breakdowns like this, or number 2 if you want me to stop here. The quiet moments are often the most important ones. And this one really matters.